Hi there, welcome to the Stockscores Market Minutes for August 30th, 2013. This week I'm going to talk a little bit about the importance of adjusting return for risk. Most investors look at percentage gain as a measure of success. We often see the media do this as well. They'll show a person's average performance over a certain amount of time, but they really don't adjust that performance for risk. You must consider percentage gain in terms of historic volatility. A stock that makes a 10% gain that routinely moves 10% is not as good of a trade as a 10% gain on a stock that rarely moves more than 2%. A $1 stock making a 10% move is pretty common, and it can go either way. But when you're trading a stock like Microsoft or General Electric, these large cap stocks, and having them make a 10% move is a much bigger deal because they likely wouldn't see that to the downside simply because the 10% move doesn't happen all that often. And so when you are judging the performance of your trades, I caution you against only looking at percentage gain. You must adjust it for the risk, the historic volatility of the stock. All right, let's get into this week's analysis. It's been a bit of a tumultuous August as the market pulls back, and really a reasonable pullback given how the market had run up and away from its upward trend line, which I've drawn here in green. Now, there's been a lot of talk this week about the conflict in Syria, and it has been blamed for some of the selling pressure this week, but realistically, the market was due for a pullback anyway. And whether there was people in Syria doing crazy things or not, I think the market was destined to pull back. I think that we've got a little bit more to go before we hit that upward trend line, but at this level, stocks are more attractive than they were at the end of July. And so I remain bullish on this market, but I'd like to see the market bounce off of that green upward trend line before I get real excited. So I do think that a little bit of caution is warranted in the short term, but my outlook remains positive for the S&P 500. Now, the Toronto Stock Exchange has been building optimism through the last couple of months. We can see the rising bottoms that I've highlighted in green. We do, however, still have that strong level of resistance that I've drawn in red on this chart, and until the market is able to break out through that, I wouldn't get too excited about Canadian stocks. There are, however, some good signs. We're seeing Canadian banking stocks show great earnings. The telecommunications sector, the cellular companies are benefiting from the fact that the U.S. carriers, namely Verizon, don't plan to come into Canada as they work on a deal with Vodafone instead, and that helped the telecom stocks this past week. And we're also seeing strength in gold and oil, and that is helping the commodity sector in Canada. So I do think that there's starting to be some optimism building in Canada, and we've had a pretty dead market for most of this year, and that could be the thing that motivates Canada to play catch-up with the U.S. market in the near term. The U.S. Treasuries have been in a downward trend for about 4 months, and this is largely because money has been looking for new places to go. It is fleeing the safety of the U.S. Treasury bond market. Well, this past week, the downward trend in Treasuries was broken, or at least the short-term one was, and that is a sign that maybe the money isn't rushing out of the U.S. as some had expected, or as we had been seeing over the last few months. And I think we could see a little bit of a bounce back here in Treasuries in the near term. And really what this is money is not going back to Europe as quickly as it looked like it was, not going back to China as quickly as it looked like it was. And so we could see, longer term Europe and China continue to improve, but in the near term, I think that Treasuries will stabilize. China did break its downward trend line, and now people are second guessing that. I think we could see a little bit more of a pullback in the China stock market before it resumes its upward trend. I do like the fact that we've got rising bottoms building in the Chinese market. And that's a good thing for the global stock market because, of course, China is such a large population, and a lot of people look for global growth to be fueled by China. So things are improving there, and that's a positive globally. US dollar bounced off of support, and again, there's a little bit of a flight to quality trade here as people worry about what's going on in Syria. There is, however, a strong reason why this market would bounce. It hit support, and I've drawn that support line in green. We've talked about it for a few weeks, how the US dollar was weak and due for a bounce back. And as we get more and more talk about potential tapering and all that kind of stuff, there is some reason for the US dollar to bounce here. I don't see great upside, however. This is a relatively volatile currency in a sideways trending range, and I think you could see it go up and down. I don't see a real strong trend developing beyond the short term. Now, gold has made its good bounce back over the last couple of months. It has now risen up to that first downward trend line, which is the lower one there that I've drawn in red, and it's likely that we're going to see some resistance building on gold in the near term here. We actually saw that a little bit this week as gold retreated towards the end of the week. I still think that gold could rally up to that higher downward trend line around the 145 on the GLD. Short term, I think pullback is probably going to happen. We had a pretty good run through most of August, and longer term, I think we could get back to the 145 and be 143 on the GLD. Oil broke out this week again because of what's going on in the Middle East, particularly in Syria. I find that these regional conflicts that happen in the Middle East tend to cause a spike in oil that rarely lasts, and so I wouldn't buy into the fundamental story of oil going higher, because fundamentally oil goes higher because global growth is happening. And not to say that isn't improving, but I think the spike in oil prices over the last week or so has been motivated by a political event, and that rarely lasts. I do, however, like the fact that optimism is building in oil, and I think that the picture is getting better for oil. I think it's probably higher in the months ahead as the economy globally starts to improve, but I just think it's a little bit risky to be sort of bullish on oil because of what's going on in Syria, because that, again, probably doesn't last a long time. Now, the fear trade, which I kind of ignored for a little while, got a little bit of a pickup this week because of events in Syria, and we can see that the VIX, the VXX, has jumped higher, but it has not broken its downward trend line. In fact, it's risen up to that. Again, likely what will happen is the market will retreat on the fear side and advance on the stock side in the near term. And I don't think that you want to get too bullish on the VXX for now, although it's certainly something to watch, because if it does break that downward trend line, then we're in a whole different game. But for now, don't get too bullish on the fear index VIX. So US stocks, I'm bullish, but I think short-term caution is deserved. Canadian stocks I'm neutral, but I do like how optimism is building, and we can get a breakout there that could lead to a nice run. Gold has risen to its first trend line of resistance, where a pullback is likely in the near term, but longer term, I think it can continue to inch higher. And oil is strong on a story, but that story can change very quickly, so expect a good deal of volatility in the oil market. Well, that has been the Stockscores Market Minutes for August 30th, 2013. Have a great week in the market and trade well.